Hello and welcome to this course on capital budgeting. The first thing that we are going to learn is what is a net present value. So let's look at what is a net present value. Net present value means we are going to use the time value of money to evaluate whether the project that we are undertaking is worthwhile or is not worthwhile. Most of the firms nowadays today use the net present value in terms of cash today, because when you are investing the money into the project, you are investing today, but the returns that you are going to get from this project, it will be in 1 year time, 2 year time, 3 years time, or 10 years time. So in order to understand whether the project will be useful for us or is beneficial for us, we discount the future cash flows to present day using a discounted cash flow method, so that we can understand whether we are losing money or not. So how do we do that? Now let's the present value, the formula for calculating the present value is present value of benefits, which is calculated at some rate, discounting rate, which we are going to talk about, and minus the present value of cost. Cost you may have to invest at the beginning of the project or maybe during the project as well. So whatever cost you have to do or you have to invest in the project, you will take the present value of all the present. So today investment will already always be at present. If you have to invest some money maybe in 1 year time, 2 years time, then you will also add to the cost using the discounted value of those future investments into the business. And then we will accumulate whatever we have are going to earn from the project, and doing the discounted cash flow method using discounting to calculate the present value of all the benefits. And then we will be seeing if the benefits outweigh the cost or not. If yes, then it normally be a yes to the project. So a very simple example we will be trying to explain you in the net present value. Sorry. Let's explain the net present value with a very simple example. Net, let's say you have an $500 today and your firm will receive $550 at the end of the 1 year. If the interest rate is 8% per year, would you rather take this money or not? Or you will give this money or not? Present value of $550 in 1 year divided by the interest rate, that is called 1.08 in 1 year, i.e. today, will be $509 today. So value of $550 after 1 year at the rate of 8% is going to be $509. But you are going to give only $500. So you are going to gain $9 at the end of the year, or you are going to gain $9 today, right? If you put this money into the bank, let's say $500 into 8%, so at the end of the year you will get $540 while you will get $550. That is another way to look at it in terms of simplification. So you will gain $10 at the end of the year, $9 at present day. So that is called discounting, and that is also called net present value. So it means you are going to get the benefit. So normally the rule for the net present value is, if you are going to you are going to get the positive net value, you are going to make the decision. And so another way to look at this problem that we have just explained is, you should be able to borrow $509 and use 550 in a year to repay the loan, i.e. you can invest 509.26 today and into the bank, and that will grow as a $550 in the 1 year. This transaction will leave you $9 benefit in today term. So the net present value discount method follows simple decision rules. If the standalone project, then if net present value is more than zero, then we accept it. If net present value is less than zero, then we reject it. What is a standalone project? Standalone project means there is no other project or there is no relationship between the two different projects. We can make this project or we can leave this project, and this it will not be effective to the other projects. Now there are some mutually exclusive project, means we can choose only between two projects. So either we invest into this money or invest into this project or invest into the project. Maybe we want to buy the factory or we want to buy the factory or we want to outsource the job. So there are two different options. You have to take only one of them. You cannot do both, right? So those are called mutually exclusive projects. In those case, we will be selecting the project where we are getting the net present value as the highest. And usually, but the problem with the NPV rules is that you cannot make the decision when the projects are of different size. For example, there may be a project which is costing you $10,000. NPV may be $5,000, but there may be another project which costs you $100,000 and the NPV is $10,000, right? So the difference between the two projects, obviously from net present value factor, the project B is better because you are getting 10,000. But from the investment point of view, you are going to spend 100,000 today. But in the earlier project, whether you are getting 5,000, you are spending only 10,000. Then this NPV rule is not going to help in making decisions for those kind of things. So how do we make decisions in those cases? We're gonna be learning that in future.